The Fed's broken, fueling America's silent depression with policies that crush workers and enrich Wall Street. But David Malpass, former World Bank president, and Kevin Warsh, former Fed governor, have bold plans to revolutionize the Fed. Malpass demands a full upheaval to boost growth and wages, saying interest rates can be lower with more growth. Warsh calls for a strategic reset to shrink the Fed's role and stop bankrolling deficits. Can their ideas save the middle class, or are they a risky gamble? Let's dive into the future of the Fed. So yesterday you had massive news that Trump had drafted a letter firing Jerome Powell, shown it to Republican lawmakers. It was a trial balloon, in my opinion, like a lot of other things that the Trump administration has done, where they float a policy to see how markets will respond. Well, the dollar sold off sharply, bond yields shot higher, and equities sold off also quite sharply. They immediately kind of reversed that, said, no, we're not thinking about doing that. Jerome Powell's term is up in 10 months or so. And we have been talking about this shadow Fed concept because to fire Jerome Powell, you need cause. And while they have been trying to lay the groundwork for cause, mainly this renovations at the Fed, alongside the $235 billion loss that the Fed has generated as partly as a result of the reverse repo operation and interest on reserve balances. While they have been laying that groundwork, I think it's much more likely that they do this shadow Fed concept. Remember, markets are forward-looking instruments. All you got to do is basically announce the next Fed chair quite early, have that person go out, indicate to the markets, hey, this is as soon as I'm in the FOMC, this is the direction things are going. And you can have pretty immediate effects as markets move to price in that future inevitability of direction the Fed is going. Now, we did a video outlining World War II and some of the Fed Treasury dynamics and yield curve control and all of that. This will tie into that. A lot of the debt and fiscal stuff. It'll also tie in heavily to our silent depression kind of framework that we've been talking about for about 2 years or so. It'll try to weave together everything. And so let's take a look at David Malpass first. I think, it's important to, if these people are going to be taking monetary policy in a totally new direction, as they indicate they are, and as fourth turnings usually do, if you subscribe to structural demographic theory, this was what happened during the last fourth turning, and it appears it might be happening again during this fourth turning, where institutions are fundamentally altered and reshaped. So Malpass, as we've talked about, debt to GDP, the secret here to getting debt down is to keep the cost of the debt below the nominal growth rate. It's really that simple. The problem is the bond market moves to price in nominal growth. And so either you surprise them with it, or you kind of force the bond yields to be artificially lower than they should be. But this is how we did it after World War II. Now, we were net productive as an economy. We are not anymore. We run a massive current account deficit, a massive fiscal deficit. We have zero industrial capacity. Unlike after following World War II, where we could rebuild the world and we had massive industrial capacity served as the world's factory, we don't have that anymore. We also were not so hyper financialized. We had a real economy following World War II. We don't really have that anymore, as we'll see in some of the slides. This kind of hyper financialization that we've talked about for a long time, that puts nominal financial asset returns and corporate profits kind of above everything else. Meanwhile, you have the kind of 99% of Americans doing worse off for the past 25 years, declining real wages. This also applies to, of course, big companies versus small companies, just as it does with the rich versus kind of everyone else. The K-shaped economy applies in many different ways. And this S&P 500, which is large companies, divided by the Russell 2000, smaller, medium-sized companies, this goes back to the 80s. This shows part of that trend. And, one of the things that Malpass has talked about is targeted credit facilities by the Fed, using the Fed to target relief for kind of smaller and medium-sized businesses. Now, I think that in general, that's probably a good direction to move things in. He's also talked about using real wages as a metric instead of inflation, which I fully support. As we can see here, here are three ways of looking at the average hourly wage in real terms, right? Relative to GDP, relative to M2 money supply. Again, inflation is a monetary phenomenon. You got to look at the money supply. And then gold, which is, again, a measuring stick for that currency debasement, that monetary debasement, that growth in the money supply. We can see that, for example, in gold terms, the average hourly wage would, 1 hour of work would get you zero point zero 0.06 ounces of gold in 2001. That number is now 0.01. That is more than an 80% decline in the real purchasing power of the average hourly wage over the past 20 years. Malpass has talked about using something like, I don't think he would denominate it in gold or M2 money supply. He'd probably use CPI, but the same concept of kind of targeting a reversal in the trend here, as we saw in the prior chart, which I will try to go back to here, that shows that real personal income. This benefited the real economy. We could see the velocity of money was growing following that World War II era boom. Post World War II era boom in the economy, we could see that velocity of money, which is exactly what it sounds like, was increasing. And look, you actually had financial assets as measured by S&P 500 divided by GDP. You had financial assets underperform GDP, the broader economy. You also had corporate profits underperform the broader economy. And so these two metrics were in a downtrend as the real average American, the real purchasing power of their personal income, and M2 money velocity, describing the degree to which money changes hands in the real economy, both of those were increasing up until the early 2000s, when clearly everything broke and China was admitted into the World Trade Organization. We really kind of accelerated the kind of hyper-globalism approach to global trade and domestic industrial policy. We also had the hyper-financialization kind of really accelerate in the past 20 years, and it's been a disaster for the average American. And the other thing that Malpass talks about is this getting, as well as Warsh, is getting the Fed out of kind of filling this hole. Now, Kevin Warsh has been a vocal critic of the Fed for a long time and said that, basically, as we can see with this chart here, I will take off federal funds rate, private bank credit creation was driving the economy during this period of time. Again, when nominal growth was very, very high, during this time period, as we could see, reaching at one point 17, 18%. We could see a clear trend change in the early 80s, both here in the U.S. population and tax revenue and nominal growth. We can see that we have been in a stagnation, a decline in the nominal growth rate. But when we delevered the system, we were in this high nominal growth environment. Now, it's important to remember nominal growth includes inflation, and generally you don't get one without the other. But here we did. So here, the difference between the white and the yellow line indicates real GDP, because here's yellow is inflation and white is nominal growth. Nominal growth is simply inflation plus real GDP. So by taking the difference here, you can see where real GDP was. And we had high real GDP and high growth, and that helped to delever the system. Now, again, much, much, much different economy back then. But, this benefited kind of the average American. As we can see, the real purchasing power of their income actually went up. I think something using a metric like this, the real purchasing power of personal income, could be a useful way to actually evaluate the Fed's success, right? Instead of this kind of technocratic approach, using something that actually benefits the average American would probably be a nice change from the direction that things have going. The direction things have been going, is the Fed through QE and the federal government through fiscal deficits have stepped in to kind of fill a void that has been left by private banks stepping away from private credit creation, from Americans having kids, and kind of this low silent depression. You had the Fed step in, right? Banks stopped lending, and the private credit creation stopped in 2008. And we can see that M0, which is government money, this is bank reserves created by the Fed, plus currency. So this government money came in and really outpaced private credit creation. During the period of time of good growth, we had strong private bank credit creation. Remember, private banks print dollars just like the Fed does. And we can also see that reflected in total private bank credit creation relative to GDP. Since 2008, private bank credit creation has not even kept pace with GDP. In fact, it's trailed GDP. So again, there's a number of areas that Kevin Warsh and Malpass have talked about targeting. The Fed, coming in to fill the void, whether it's through private bank credit creation, whether it's the government more on the fiscal side coming in and running these utterly insane deficits. The deficit is 7 times worse, 7x worse than it was in 2007. And despite that, or in spite of that, we have an unemployment rate that's actually lower. So this is something has clearly kind of broken where the Fed is stepping in to subsidize those fiscal deficits. QE is being engaged in. Here is one way to look at this. So here's the Fed balance sheet. And we can see that this quantitative easing, this Fed stepping in to fill the void, has been great for the top 1%. QE has made the net worth of the top 1% grow significantly faster than GDP. And we can see that reflected by the yellow line going up. It has also made financial assets much more unaffordable. As the red line is going up, that is indicating home affordability is going down. So quantitative easing, if you're rich or if you hold financial assets, quantitative easing has been great for you. If you work for a living, and want kind of the middle class life your parents did, it's been not so great for you. In fact, we can see median home price relative to the median family income. We can see that decline as the Fed engaged in quantitative tightening here during the last Trump administration. It actually made affordability better. But in general, the trend here for the blue line is up and up quite significantly. Now, we find ourselves in a tough position where a lot of the metrics that I've looked at, personal income in logarithmic form, GDP in logarithmic form, these have all broken from their trend. When we had that very, very high nominal growth environment where tax revenue was soaring, the native U.S. population, right? People were having babies, the population was growing. We had a very, very strong economy, ultimately kind of getting too strong, one could argue, which is what resulted in some of the inflation that we saw into the early 80s, which caused the Fed to hike rates, and ultimately kind of destroy that trend with higher interest rates. Well, we had personal income growth growing quite robustly compared to the trend rate of growth. Now, depending on how you draw this trend line, this translates to like $100,000 to $150,000 per year per person, by the way, in missed personal income growth. GDP in logarithmic form shows a very, very similar thing. During this high growth environment, you had very, very strong GDP and higher interest rates to compensate for that higher nominal growth environment. Again, monetary policy acts with a lag, interest rates act with a lag. And we can see that, shortly after the peak in rates is when these trend deviations started to occur. And we kind of fell into this much lower trend rate of growth. This, of course, has been affecting the average American, as we can see here, and it has also been affecting small to medium-sized businesses. Kevin Warsh and Malpass both kind of target different things. So Malpass seems to target the small and medium-sized business, the real purchasing power of the average American's wage. That is what Malpass seems to kind of focus more. Warsh seems to be more of kind of a Fed critic in saying that, the Fed, the degree to which the Fed has stepped in and fiscal deficits have come in, pro-cyclical deficits, that is kind of more Warsh's argument, is that those are what is dangerous. Now, here we can see the Fed balance sheet as a share of GDP back here was about 6%. Now it's 22%. So the Fed balance sheet has grown 3 times faster than GDP. This is kind of the Kevin Warsh argument. The Fed is playing a huge role in the economy that they really shouldn't be, and that we need to rein in the size of the Fed. He's also talked about the Fed's kind of regulatory side, right? A lot of people don't know this, but the Federal Reserve, one of their big missions is bank regulation, financial services, and the regulation of the financial system, reining that in. Famously, the Fed got caught in that whole ESG sort of thing. Kevin Warsh was very critical, said the Fed has no business trying to mandate climate goals or equity goals, societally. So he's been a big critic on kind of reining in the size of the Fed, and also, the degree to which they're subsidizing basically by buying bonds and keeping interest rates artificially low, subsidizing these massive, unheard of fiscal deficits. This is kind of the degree. The angle that Kevin Warsh comes at the Fed, which is we need to get it back with a goal of monetary policy. We got to reduce the Fed balance sheet. We have to reduce the kind of entanglement with the fiscal side that we see, and that's partly QE and the bank bailouts as well. He thinks that targeting a fixed inflation rate rather than this data dependent sort of range, and this kind of ephemeral sort of approach to Fed monetary policy. He talks about targeting a firm 1 to 2%. Currently, it's 2% that the Fed tries to target as a long-run inflation average. He talks about 1 to 2%, or even using the Taylor rule. And he talks about lowering rates. Both Malpass and Kevin Warsh talk about lowering rates. Now, the problem is that by lowering rates, you spur that nominal growth that we were looking at here. And part of nominal growth, as we saw here with inflation, part of nominal growth is inflation. Well, what does the bond market do to protect itself from losing money in real purchasing power terms, losing money on bonds? Well, they demand higher interest rates. That is what we see. We see, especially at the long end of the yield curve, we see rates moving higher. So in a higher nominal growth environment, rates will be higher. And again, the trying to get low rates but high nominal growth indicates one and one thing only, which is somehow they will force bondholders to take losses in real terms. That is really what they are saying. And Scott Bessent himself, the U.S. Treasury Secretary, has said this as well, which is we got to get nominal growth above the interest rate on the debt. And sure enough, if we do that, if they are successful in getting the cost of the debt below nominal growth, that will work. That will deleverage the system. The problem, again, comes from that inflation that comes along with high nominal growth, as we can see here. Now, again, there is a world where you have, 5% inflation, but you have wage gains, say 6 or 7%. So we have all been conditioned over the past 5 years, so traumatic, the great inflation, to hear inflation and automatically think that we're going to get poorer. But it is possible, theoretically, to have wage growth outpace inflation, right? Where both are elevated, where you have wage growth at, say, 6 or 7% per year, and inflation at 4 or 5%. That is, even though there's inflation, that is a real wage gain in real purchasing power terms. That would kind of rebuild this what I would call healthy, productive economy that we had, that my parents' generation had, where you had very, very high nominal growth rate. Corporations did not benefit that much. They actually corporate profits trailed aggregate U.S. economic growth as measured by GDP. Financial assets underperformed GDP, but the average American, the kind of bottom 90%, they outperformed and their purchasing power went up. Sure enough, they spent that money into the real economy, where you had small and medium-sized businesses. Nowadays, we have kind of gotten to a point where those are gone, and we have this kind of hyper-financialized mess, where as the velocity of money has fallen, the thing that has indicated that has stepped in to kind of fill the void of the real economy dying off is hyper-financialization. This is driven also by trade policy, globalization, issues with the dollar that we have addressed. But we can see that with the degree to which S&P 500 financial assets have outperformed the average hourly wage, We can see that quite notably in this chart. So, talking about a world where maybe it's not as great for the net worth of the top 1% or for corporate profits, but this average hourly wage, the bottom 90 something percent, where this actually starts to grow faster than GDP, faster than inflation, and you see a reversal of this 20 something year downtrend, that theoretically could work. Again, the problem comes with to try to say that you can have high nominal growth without elevated inflation. I think is while theoretically possible, going to be quite difficult for them to actually enact. Now, the other thing is David Malpass has talked about interest expense. And again, both of them are talking about lower interest rates. And so, again, that comes down to you can't have lower interest rates and higher nominal growth without something there to force bond yields lower, in my opinion. But David Malpass has talked about this world of higher nominal growth and in an effort to reduce interest expense. Here we can see nominal interest outlays are over $1 trillion per year. Interest as a share of GDP is right near an all-time high. Now, remember, debt to GDP was much lower back here in the early 90s. The last time it was 5% of GDP. So it's a much, much, much different scenario. We also had falling rates kind of coming out of that, which I don't think is the natural direction of interest rates. Now, if they come into QE and yield curve control rates down, then you're gonna get inflation. Like there is no magic bullet here. But both of these people have some pretty bold proposals, getting interest rates down and then kind of forcing interest rates down synthetically or artificially, and then financing the debt at negative real rates. That will help with interest. And that is one of the fastest growing budget items for the U.S. government. We can see that the average American has really not done well, and the higher rates arguably caused or were part of the cause of the break in trend that we saw following the early 80s, where we had this period of very, very high nominal growth, which was bringing us out of the high debt to GDP. It was deleveraging the system. But then those high interest rates started to bite, along with other factors, of course, that kind of threw us off that trend rate of growth. And basically, they are trying to stimulate through lower rates. They are trying to stimulate our way back up to that trend. And I think while theoretically possible for some of these things, while theoretically it is possible to target the real purchasing power of the average hourly wage as the mandate for the Fed instead of some inflation target that changes and no one ever really knows what it is. I think that's great. And theoretically, I think that that would be massively beneficial to orient the Fed towards helping small, medium sized businesses, which have been crushed for the past 5 years at least, if not 10 or 20 years since China's admission in the World Trade Organization, for example, crushed tons of domestic industrial production. I think some of these things, while theoretically good, forcing interest rates lower would definitely help spur growth. The problem becomes, again, you're having to force them lower somehow. One of the ways you can do that is by QE. We established in one of the prior slides here that QE is massively beneficial for the net worth of the top 1% and for financial assets, right? So getting QE to force bond yields lower, to make interest expense lower, but also on the other hand, trying to help the lower leg of the K. That I'm not so sure if you can really do both at the same time. Kind of by definition, QE pumps financial assets much more than say CPI, consumer prices. So QE or yield curve control, in order to get that interest expense down, which both of them have talked about, and in order to spur growth, which both of them have talked about, really the only way you get lower bond yields but higher nominal growth is by suppressing the bond market, by financial repression and negative real rates. I don't see how that's not massively beneficial for financial assets, for the net worth of the top 1%, which hold those financial assets. So, they have quite a tricky situation, and we've been in a multi-decade long trend where the average person has been getting just absolutely crushed as corporate profits outpace GDP. In fact, corporate profits as a share of GDP have doubled over the past 25, 30 years. And the net worth of the top 1%, right? The rich get richer. Their net worth is outpacing GDP growth. Meanwhile, the average hourly wage is massively underperforming GDP growth. Some of these trends go back a long time, and some of these problems are quite difficult, and they come with trade-offs. And I think higher inflation is probably one of them. Now, Kevin Warsh, in his targeted statements for reducing the size of the Fed, that I think is positive. But again, how do you have reducing the role of the Fed and the government which has stepped in to run these huge pro-cyclical deficits and then subsidize them by QE, right, by the Fed printing money to buy U.S. Treasury bonds and keep rates low? How do you rein in the size of the Fed while also engaging in quantitative easing or yield curve control in order to get those rates down artificially? Again, remember, they have to be forced down if you're going to have not higher nominal growth. I don't see how you do both of those. I don't see how you rein in the size of the Fed, rein in wealth inequality, but force bond yields lower than they really should be and have higher nominal growth. Like, some of these things seem to be in conflict with each other. I appreciate that at least some of these issues are starting to be talked about, and maybe we might start to see at least a directional change towards policy that really kind of addresses some of these kind of silent depression, forgotten American sort of issues that we've been talking about a long time. That is welcome news, but like, they got a very difficult battle here, and some of these trade-offs that they're going to face, I think, are quite difficult. I just do not see how you reduce the size of the Fed without quantitative easing. Well, how do you do both of those? Those are mutually exclusive. You need to expand the Fed balance sheet in order to engage in quantitative easing, which is what you need to get rates below the nominal growth rate. To get rates lower than they really should be, you need kind of artificial suppression, like we did after, in the 40s during the last fourth turning. I'm not saying it's impossible, but there's another consequence, which is higher inflation. Now you get interest down, and that's beneficial from a deficit perspective. But again, by financing those lower rates, by expanding the Fed balance sheet, that's going to spur inflation. And there really is no silver bullet here. But the fact that they are at least talking about things like the real purchasing power of income, the real purchasing power of the average hourly wage, I think is a step in the right direction. I just think that some of these things are so deeply entrenched and the trade-offs are so pronounced. We have let things get to such a degree that some of these trade-offs are just inevitable. I don't see how you get some of these policies that they're talking about without consequent, increase in wealth inequality, increase in financial asset prices, higher inflation. Some of these things are kind of in conflict with each other. So while the talk is appreciated and the addressing some of these issues is certainly appreciated, I think, by most Americans, actually accomplishing it is going to be very, very difficult. So definitely is something to keep an eye on, and we will. And hopefully that was somewhat of an explanation on kind of some of these new proposals and the direction that things might be going. At least if these two guys who are in the up at the top in the running for next Fed chair, at least if they are the next Fed chair. But I think regardless if it's not David Malpass or Kevin Warsh, like, I think regardless of who it is, I think that there will be some pretty bold ideas and pretty bold changes. Yield curve control alone, or massive QE to get bond yields down so we can quote unquote grow our way out of the debt, that alone would be a massive change. It would basically be a reversal of the 1951 Fed Treasury Accord, where it granted the Fed independence. Now we're going into fiscal dominance again, where the Fed has no independence. So definitely interesting times, and we will keep watching this and keep trying to explain what's going on. So, anyways, hopefully that was helpful, and I will catch you in the next one.